Should you buy treasuries in a tax-advantaged retirement account or not? Inflation data and bond yields from last week, plus the upcoming week's auctions and yield expectations for some of those auctions. Hello, members, super savers, and bond course fans. I hope you're having a good week. These are the 3 topics that we'll be covering in today's update video. As with last week's Treasury update video, we're going to kick off this week's update video with this Diamond NestEgg community question of the week. Should you buy treasuries in a tax-advantaged retirement account if brokered CDs yield the same or more? Here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Here is our Diamond NestEgg community question of the week. Do pause the video here if you wish to read through the details. But to summarize, our super saver member wants to know, why buy treasuries in a 401k if interest earned on those treasuries lose their state and local income tax exemption in this type of account, and non-callable brokered CDs with the same maturity often pay more? Now, our member speaks about a tax-advantaged company 401k retirement account. But I'm going to address this question from the perspective of a personal IRA, because most employer-sponsored 401k plans don't generally allow the purchase of individual bonds, whereas most personal IRAs do. But the principles should be the same for most types of tax-advantaged retirement accounts. Bond course folks, please refer back to Bond Masters Module 2, which bonds might be right for you, and specifically to this video on taxable versus tax-advantaged accounts. If you need a brush up on anything we're talking about in this section of today's video, or if you want to review which type of account might better suit the type of bond you're interested in, be it agencies, corporates, or munis. So, as I said in that Bond Masters video, all else being equal, meaning that if we set aside factors such as risk-return profile, liquidity, callability, and so on, with an IRA and most tax-advantaged retirement accounts for that matter, you would generally choose the higher yielding bond or CD with the same maturity. Because interest earned on treasuries, other types of bonds, and CDs are taxed in the same manner when held in a tax-advantaged retirement account as ordinary income upon withdrawal from a traditional IRA and not taxed at all upon withdrawal from a Roth IRA, assuming you meet the standard requirements for that account type. Which also means, as our super saver member points out in the question, that in a tax-advantaged retirement account, treasuries lose the tax advantage that they normally have over CDs because, remember, in a normal taxable brokerage account, treasuries are exempt from state and local income taxes, while CDs and most other types of bonds are fully taxed. Now, at the time of this taping, the highest 10-year non-callable brokered CD is paying only a very tiny bit more than a 10-year U.S. Treasury note. The highest yield is 4.45% on the CD, and the yield on the T-note is 4.42%, as you can see here. Like I said, only a very tiny bit more, but nonetheless more. Yields do move regularly though. So let's say you're hanging out on Fidelity's fixed income screen, because that's what people do, right? Anyway, let's say you find a non-callable brokered CD that pays 10 or even 20 basis points more than the equivalent term treasury. You might be tempted to just go for the higher yielding CD, and there would be, in many cases, nothing wrong with this decision. However, there are some good reasons why an investor might still choose the slightly lower yielding treasury over a higher yielding CD with the same maturity in a tax-advantaged retirement account, such as an IRA. Here are 3 of those good reasons. Reason 1, higher liquidity. Generally speaking, a treasury bill, note, or bond will be more liquid than a brokered CD of an equivalent term. Remember, treasuries as an overall category are considered to be the most liquid fixed income investment in the world. So if you want to stay as liquid as possible in your IRA, for example, if you foresee some RMDs coming up soon, you may want to forego the relatively small yield advantage of the brokered CD and go for the generally more liquid treasury. Reason 2, simplicity and safety when buying larger volumes. Keep in mind the standard deposit insurance coverage limit is $250,000 per depositor, per FDIC insured bank, per ownership category. So an investor who wants to buy more than that amount while still staying in the safe zone, so to say, would need to diversify the ownership categories by adding a new joint account for their additional CDs, for example, or by spreading the risk out across multiple banks and buy more than one CD. With Treasuries, an investor can buy up to $10 million per auction and as much as they want on the secondary market. Plus, no matter how much that investor buys, that amount is guaranteed by the full faith and credit of our government. Reason 3, personal preference. Now, reasons 1 and 2 would most likely make me lean towards Treasuries over an equivalent term non-callable brokered CD if that CD paid just a tiny bit more. But for some investors, reason 3 is much more personal, but often decisive. Some investors simply prefer Treasuries over CDs. We see this quite often on our channel when we go through all your comments and questions. And likewise, some investors simply prefer CDs. And there's nothing wrong with either choice. Everyone's financial journey is different. At the end of the day, you need to choose the bond or CD that best suits your individual situation and preferences. And for some folks, myself included, one or more of these reasons is enough for us to swing towards Treasuries, even when the yield on an equivalent term CD is just a tiny bit more. Of course, and as I mentioned earlier, yields on Treasuries and CDs do move regularly, so do check both when you're making your decision to see if the yield difference between the two might be material for your IRA. Now, let's move on to the next section of our video. So, as we often do these days at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday. And here's where yields stood at the end of the previous week. With the exception of the 2-month T-bill, which remains unchanged, bond yields were down overall this week, primarily driven by inflation reports that showed inflation did not continue to accelerate last month. The Producer Price Index report released this past Tuesday was mixed, but the Consumer Price Index report, CPIU, released a day later, showed that inflation cooled for the first time this year. It was the first CPIU report in 2024 where inflation did not come in higher than expected. This, coupled with reports of slower April retail sales, led to a bit of a celebration in the market and resulted in increased bets that the Fed would cut rates sooner rather than later, as well as much lower bond yields on Wednesday and Thursday. Bond yields did recover a bit on Friday, however, after several Fed officials reiterated that interest rates should stay higher for longer. As I mentioned earlier, though, with the exception of the 2-month T-bill, which remains unchanged, bond yields were down overall this week. Now, relative to the beginning of 2024, bond yields are practically all still up, as you can see from this table comparing Treasury yields from this past Friday versus January 2nd. This row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. The 1-month and 2-month Treasuries are still a bit down, with the 2-month down the most. The 3-month T-bill is unchanged. Otherwise, rates are still higher overall across all the other maturities and noticeably higher on the medium and long end. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Resource Center website here. All sources are linked below in the first pinned comment. And because some of you have asked, these rates that the Treasury publishes on every trading day, they are meant to give an overall picture of the market at a specific point in time. The price you will actually pay when you invest in a Treasury bill, note, or bond may be a bit different from what you see here. If you're buying at auction, your rates will depend on the results of that specific auction. And if you're buying on the secondary market, your rates will depend on your purchase volume and which broker you buy from. Bond course folks, please refer back to these videos here for a refresher on new versus secondary market bond issues and pricing. So that was a recap of bond yields from last week. Now, let's take a look at the upcoming week's auctions and yield expectations for some of those auctions. So here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. The 42-day CMB that is normally on the weekly schedule is actually a 43-day CMB this time, and it is a reopening auction. Some of you did suggest that the reason for the 43-day CMB instead of a 42-day CMB is so that the maturity date would fall on the 5th of July rather than the 4th of July. That's the best explanation that we've heard so far. But if anyone from Treasury Direct is watching this, we'd love to hear from you with an official or unofficial confirmation. And if we scroll down further, we can see that the 20-year T-bond and this 9-year and 8-month TIPS, a reopening auction of what was originally a 10-year TIPS, will also be happening this coming week. At the time of this taping, here's what the coupon and the expected yield are for the 20-year T-bond auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 10-year TIPS reopening auction. Do keep in mind that these numbers can and usually do change all the way up to the time of the auction. If you have a particular interest in either of these auctions, then do come and join our next Super Saver live member Q&A session on Monday, May 20th at 5:30 p.m. Eastern Time, because we'll be covering both of these further then. So I hope you enjoyed this update video and learned something new. And if you did, I'd love to invite you to take a look at this video here on one of our 2 brand new bond courses so that you can take advantage of some of these anticipated higher for longer rates. Or check out the links below this video for more details on our bond courses and YouTube Super Saver membership. All right, member Super Savers and bond course fans, good luck to everyone who's planning on buying at the upcoming week's auctions, and see you again very soon with more brand new wealth building content for your financial journey.